Hey, my matey, are we ready to sail the seven seas of magic and wonder as we go on a cruise of a lifetime to Jumanji? I thought it was the cruise of a lifetime. Oh, Indiana Jones, yes. No. We're talking about Royal Caribbean. Yes, RCL, this is the stock analysis, intrinsic value just for you at home. Welcome, guys and gals, back to Barry Charles. This is the one place that you get your finance news, bang, 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 give you the opportunity to understand a little bit about stock analysis and look at the intrinsic value. If you stay right to the end of the video, you will get a potential intrinsic value of Royal Caribbean. So let's get into it. We're going to talk about Royal Caribbean right here, right now. Let's get to it, a stock analysis. Welcome back, guys and gals, to the channel. Yes, RCL, the company that continues to turn around what has been a sad 4 years for this company, but it is starting to sail up in our way to the top of the ladder. Yes, as Royal Caribbean really continues to say, I am number one. The argument CCL is number one. You can argue either way for years, but if you go on market value, then RCL wins every day of the week. But yes, let's get to it. We're gonna have a little dive into the financials here. First, we're gonna look at the revenue, net profit, earnings per share, P/E ratio, dividends if they got them, total assets, market cap, free cash flow, return on invested capital, and a few other things. We talk about it all, and then we come up with a little bit of where can Royal Caribbean continue to grow to make the business grow if they want to go to level. And I'll finish off right at the end, talk about the intrinsic value of RCL. Yes, well, let's get to it. Let's have a look at revenue. What has revenue been doing over the last year or two? Well, in 2022, the company started turning it around with 8.8 billion. And last year, they've jumped up to $13.1 billion. Yes, congratulations. You and CCL are starting to turn the corner. Now, the big difference between the two companies here, why RCL, I believe, is more of a premium stock and why people want to buy the stock more. Net profit in 2022, minus 2.1 billion. And then 2023, they've hit profitability with 919 million. So, yes, even though CCL did improve their situation big time as well, in a more dramatic way, they lost. Yeah, so that's the thing you got to look at. But they are profitability first. Yes, RCL are more profitability first, and have always been more profitable generally than Carnival Cruise Lines. Earnings per share at the moment is about 6.63, so you'd like that to probably go up. P/E ratio of 18.8, so it's getting a little bit on the pricey range if you think this company's not really a big growth machine. It's probably getting a little bit higher, the P/E ratio. The 52-week range, well, congratulations if you're at that $59 mark. And commiserations, no, this is around 127 right now. It's the high. So, yes, another company that some people would have doubled up on and some people that have lost a lot of money in. But if they stay true, they'll still be losing money. But if they keep buying, they would accumulate more. So that's the thing you've got to think about, folks. Now, I just wanted to go a little bit off topic for a second, not off topic, but yes. So if you're investing into a stock that has dropped big time and you've been in it for a long time and you still believe in the company's going to turn it around, no matter what, you just keep buying. If you believe it's going to go above and beyond where you think it was previously. Where RCL's got a little way to go, so does cruise lines. But if you believe that, you go and invest. Not financial advice, but it's something you got to look at. And the prime example, there's a lot of stocks, but I'm taking my own examples. I'm not taking anyone else's examples. I'm saying, yes, I bought this stock when I never bought it at all. But Meta, yes, Meta was a prime example in 2022. This was one of the stocks you should have been buying, dropping from over 300, getting close to the 400 mark, not quite, but around that mark, and then it plummeted. It plummeted about 270 initially, and you thought, oh yeah, let's just buy that dip. Or I started buying a dip at 320. I went too early because it dropped quickly. And that's just the way the stock market goes. You didn't foresee it to continue to drop after COVID happened. You would think that this stock market would have gone a bit solid, but it went boom. Yep, it went crashing down the earth. It went down 150, 120, stayed there for a while. Went down to about $88 a share, folks. Yes, $88 a share. And now, boom, it's nearly 400. So that's just an example of what can happen with Royal Caribbean and Carnival Cruise Lines. A little bit slower motion, and it's understandable because they just don't have the acceleration as possible, even though their revenue acceleration has been good. But if you compare it to where it used to be, it's a long way to go. But yes, that's just a little bit of a diversion, just to give you an example of what it can do for you in terms of going to buy the dip. But you can also buy the dip on a stock like Smile Direct Club, and you go to bankruptcy. So that's just giving you an idea. There is different ventures, there's risks around every single investment you make. It doesn't matter how good the company is. If someone does something dodgy at a big company and they go down and they're down and out completely, then it can be all catastrophe. It's happened many times before. So thankfully, I have not been in a stock that's gone to that level. Thankfully, there's been stocks that have been potential to go to that level, and one of them is Beyond Meat, still around at the moment, but will it continue? Thankfully, I got out well and truly before where it is now. Whew, imagine if I kept on to it to $6. You never know. Beyond Meat can turn it around and go back up to the hill. Well, it's obviously going to have to find a way to grow again and all that stuff. It was a big fad, and the big fad so far has been AI, and so far there's been a little bit of deliverance on it, and then some not. Like obviously in the video, you're getting big gains there, but some of the other stocks are struggling a bit. It went up high and then dropped again. Palantir is an example of that, but I have full inclusion that Palantir can do something in the future. But getting back to RCL, folks, yes, let's get back to what's happening with RCL. They have no dividend at the moment. Potential for a dividend to return. We will see if that happens. But obviously, get into profitability, there's a potential they can do it. Short interest is about 7% on this company. Market cap, $32 billion, folks. $32 billion, yes. Has Carnival Cruise for lunch at about $21 billion. Total assets of $33.7 billion. It's down $1 billion to 32.7 in 2023. I'm not sure why that is, but it's something that. But when you compare it to RCL, who has $51 billion or around there, you got to think to yourself, it just doesn't make sense, does it? How come this company's $9 billion more? It just shows you it's about premium quality business, or what is perceived quality business. Because when I look at return of invested capital, only 6% and 12% for Carnival Cruise Lines, I start going, how can that be? But this is where it is, folks. This is where, this is where the difference is here, is in terms of long-term debt. 20 billion down to 17 billion. So they have really cut down 3 billion. And they have from a negative 2.2 billion to a positive free cash flow now of 2 billion. So in terms of paying off their debt, it will take them about 8 years to pay it off, or 8.5 years, compared to 28 years for CCL. So that's where the differences between the two stocks is primarily on their long-term debt. That's probably the biggest difference at the moment, but obviously they have more assets to sell, CCL, so you can argue that. But again, with the cruise ship lines, you are getting absolutely stung with shares outstanding, from 209 million in 2018 to now 256 million. So absolutely about 25% loss of shares just on owning the stock. You've been devalued over the last 5 years. Have you been in the company? So that's not a good sign. But yes, obviously it's all about growth. Can they continue this growth going forward? There's more and more people in the world, yes, but can you get to enough destinations, and can you add more destinations that are profitable? That's all stuff that cruise lines are all dealing with, because they already are in a lot of places already. Can they go to new places that are not really been adventured yet? That's the biggest issue that those companies have at the moment. I don't think the number of people is never going to be an issue. I think you're always going to have more and more people. It seems to be the world just gets bigger and bigger and bigger. It's just whether or not you can get that market to consistently keep coming to you. So so for me, RCL, we're going to look at the intrinsic value. This is what you were here for. This is what we're here to talk about. Can we get yourself some $1 million right here, right now, in the intrinsic value? Well, let's see. So we're going to look at the stock price at around $125 for the stock. Just to give you an idea of this calculation, so it's the current share price with earnings per share, a potential growth rate you see, the current bond yield, which gives you a rough intrinsic value. I use Trade Brains Graham's calculator, which you can get. There's more than just that calculator, but there's heaps. This is just a nice simple tool to just give you a little bit of emphasis on what intrinsic value of a company is, and then you can add different layers on top of that to give yourself an idea of what you think intrinsic value is. So yeah, with the current earnings per share of 6.65, with a growth rate of 5% on the current stock price, we get $127. So pretty much fair value right here, right now in the stock. If you think the company's going to stay the same and grow at 10%, with the same earnings per share, you're getting close to $200. Then if you think, yes, the earnings per share is going to rise over time, it's going to go to 9, and the growth rate will stay about 10, then you're jumping to $267. And if you think this company's going to fly to the moon and nearly double earnings per share to $12 and 50% growth, then you're looking at a $481 stock in the future. What do I think? Do I think that's feasible? I think there's, well, I won't say no chance. I was going to say no chance in hell, but in probably 50 years time maybe. But yeah, I just not convinced, because obviously businesses will grow over time generally, not always, but be slow growth, but I think you'll be waiting a long time for it to get to anywhere there those levels, but anything can happen. Obviously dividend will be a big one for this company. If they would come back to a dividend, obviously I think the stock will double nearly, right then with dividends. Mine not quite double, but at least 50% easily if they return the dividend for mine, because people love their dividends. But your growth's the story. Can they continue to get profitable, cut down their debt? Obviously with these cruise ships, debt has been always high on this company, but it's obviously been exaggerated lately. Can they cut down their debt as they move forward? Time will tell. But anyway, that is RCL, stock analysis and intrinsic value. My intrinsic value, sorry folks, I didn't say my intrinsic value. My intrinsic value on this company, if I'm looking, say, long term, where I see solid growth, I think I'm pretty confident you'd get to $200. No problem with this company. Could potentially go to $300 over the long term. But that would mean, for me, to buy the stock, has to be 100 or less. Have I missed the boat? Yes, absolutely. Anything can drop at any time. If it goes under $100, there will be a potential for me to look at buying the stock. If it went to something ridiculous, then even more. But as you'll learn on this channel, I invest in very few stocks. Now, some people say, well, what are you doing? Are you crazy? No. Way I see in investing, you just invest into good quality companies at great prices, just like Warren Buffett, Charlie Munger, Manish Prabhai, and all the others around there. You just buy them at nice prices and let it go, because it can be sometimes a fool's game to go for the risk, but you can get a lot of reward too. Don't get me wrong, some people, you could potentially buy into 100 stocks, the lowest stocks in the world, one goes up world over. Tesla is an example for some people. Alf Beauty's been an example. I mean, even Microsoft and Apple back in the day. If you were in it back in the day, well, congratulations to you, because there wouldn't be too many people that took their risk back then. So I'm not saying that strategy is not a right strategy. It can work for you, it can work for others. But for me, just nice, slow, steady returns over time. No problem at all. I'm obviously looking for that growth in the company, continued growth, that this company's going to continue. You don't want to stagnate company. That's why I'm not in the cruise lines at the moment, even though they have really improved in terms of currently. But again, I expect they will go flat eventually in a few years' time. And that's the problem. Where does the growth come from for those companies going forward? And that's what I add the dividend in. But yeah, that's a question mark for you to decide. But anyway, that is RCL stock analysis. Remember to like and subscribe to the channel. Share this video with all your friends as we get to learn more about the stock market and get financially independent. Have an awesome day out there.